Yeah, look, so ARM is a unique asset and it's got some fantastic levers it can pull in terms of market share gains, in terms of content, in terms of royalty rate and so forth. But the pricing is expensive. It's expensive both on a revenue multiple, on an EBIT multiple. You've already talked about the earnings multiple as well. And so I think a lot of investors are sitting on the sidelines because, it's a relatively small free float. I think a lot of investors are sitting on the sidelines and waiting to see how they execute on those drivers, right? And the other key point, I think, is the margin accretion that's expected. This business pre-SoftBank ownership was at a margin of around 40, almost 50%. That went down to almost zero during the SoftBank ownership, and now we're on a path back towards about sort of 29%. And if you look at the guidance in the F1, that's expected to hit 40 in 2024, and then upwards of 60. That's a very big hill to climb, and I think a lot of people are waiting to see the execution before they really get involved in the IPO.
Well, I suppose then, Ben, the element here to kind of note is that, well, they've had constricting demand when it comes to the number of shares put out. They kind of priced it the right way in many ways. A win overall, you'd say, then, for ARM, particularly though for SoftBank here.
No question. They've got, what are we at now? 68 billion, right? That was the kind of range that Massa was looking for, 9 months ago. He was looking for sort of 70 billion. That range then came down to the 40, 50 billion. So, yeah, he'll be very happy. Don't get me wrong. I think this is really good for tech sentiment. I think it's really good overall for further, as you say, follow-on IPOs. But, the valuation is one of the sort of risk points or stretch points, I think, for a lot of investors. What's going to be interesting for me as well is, what allocations the strategic investors got. I'm sure you've covered, the large number of strategic investors, the great and the good of large tech and semiconductors, and what allocation that they actually get and their future participation, I think, is also going to be key.
Ben, it's Arjun here. I just was interested in the margin story, and I just wanted to get your thoughts on what you believe is going to drive that. Is it around ARM's ability to increase royalties? Is it around new products? What's going to drive that margin growth?
Yeah, so look, ultimately it's going to be about them being able to do 10% plus revenue growth. Market growth is going to be around 7, something like that. But through a combination of market share gains, that's obviously not in smartphones where they're extremely dominant, but in places like automotive, cloud computing, there's some share gains to be had. There's also content, so taking more of ARM's IP blocks, right? So historically you would have taken a processor. You might have taken graphics, but increasingly you might take a security IP block. You might take, other things to help you basically get to market quicker as well. Also, you touched on an AI ML block that they've got as a relatively new product. So that's increases in terms of content. And then finally, yes, the royalty rate is a big driver. So we're moving through a transition from the V8 architecture to the V9 architecture. And historically, you've always seen an upgrade in terms of the underlying royalty rate. And that can be a big driver. On a blended basis through the business, royalty rates could move from 2% up to 3% over a number of years. So again, that's all about execution. Now back to the margin, that's about that revenue growth, but then it's also about obviously growing, operating costs slower than that top line. And so, we shall see how they spend on R&D going forward. Clearly, this is a very IP-rich business, and so I think some investors are a little concerned that if R&D grows much slower than revenue growth, that could be impeding future growth.